Your portfolio might be worth millions today. But according to Harvard economist Kenneth Rogoff's analysis of 800 years of financial crises, 87% of all assets lose their value during systematic collapses. While governments promise your savings are safe, history reveals a different story, one that repeats with terrifying precision every few decades. The last major collapse was 2008, making us statistically overdue for the next one. But here's what the wealthy elite don't want you to know. Throughout every financial apocalypse in recorded history, three specific assets have not only survived, but made their owners incredibly rich during the recovery. From the Roman Empire's monetary collapse in 274 AD to the 2008 subprime crisis, these three wealth preservers have protected fortunes while paper assets burned. In the next 10 minutes, I'll reveal exactly what these three crisis-proof assets are, show you the historical evidence of their performance during civilization's darkest financial hours, and give you the precise steps to acquire them before the next inevitable collapse destroys unprepared investors. Because when the financial system breaks, and it will break again, you'll either be a victim or a beneficiary. Let me take you back to Constantinople, May 29, 1453, the final day of the Byzantine Empire. Emperor Constantine the Byzantine, Palaiologos, stood on the walls of the greatest city in the world, watching Ottoman cannons shatter defenses that had protected Christian Europe for over 1,000 years. But this story isn't about military conquest. It's about what happened to wealth during civilization's collapse. As Mehmed II's massive army surrounded the city, Byzantine nobles faced an impossible choice: flee with whatever they could carry or stay and fight to the death. The smart money had already moved. Months before the siege, wealthy merchant families like the Cantacuzenos had quietly converted their Byzantine gold solidi into three specific assets: land outside the conflict zone, precious metals they could physically transport, and shares in profitable trading enterprises that operated across multiple empires. When the city fell and 100,000 Byzantine solidi in the imperial treasury became worthless overnight, these families emerged from the chaos richer than before. Picture the scene. While common citizens watched their life savings disappear in smoke and flames, prepared families loaded ox carts with portable wealth, traveling to Venice and Genoa, where their diversified assets waited. The Byzantine currency died with the empire, but land in Crete still produced olive oil. Silver still bought safe passage, and trading partnerships still generated profits. This wasn't luck. It was understanding which assets survive when civilizations crumble. On May 29, 1453, at dawn, the final assault began. Mehmed's cannons, some weighing 19 tons and firing 600-pound stone balls, punched through walls that had stood for a millennium. By evening, Emperor Constantine lay dead in the rubble, the last Roman emperor after 1,480 years of continuous rule. The human cost was staggering. 4,000 Byzantine soldiers died defending the walls, while 30,000 civilians were enslaved or killed in the three-day sack that followed. But here's the part history books miss. While ordinary citizens lost everything, the prepared wealthy families who had converted their assets months earlier were already rebuilding their fortunes in new locations. Take the Cantacuzenos family. They lost their Constantinople palaces worth 50,000 solidi, but their Venetian real estate investments, precious metal reserves, and trading partnerships in Genoa generated 75,000 solidi in income within 2 years. Meanwhile, families who trusted in Byzantine currency and local investments were completely ruined. Master craftsman Georgios Francis, who kept his life savings of 2,000 solidi in the imperial mint, lost everything when the Ottomans melted down the currency for scrap metal. His neighbor, silk merchant Anna Komnenos, who had invested in Genoese trading ships and owned silver mines in Serbia, emerged from the conquest wealthier than before. The pattern was clear. Byzantine currency died with Byzantine political power, but productive land still grew crops. Precious metals still held value across all empires, and profitable businesses still generated income regardless of which flag flew over the city. Within 5 years, Constantinople had been rebuilt as Istanbul, but only those with portable empire-independent wealth could participate in the new prosperity. Fast forward 570 years, and the same three assets that saved Byzantine wealth are protecting modern fortunes today. During the 2008 financial crisis, while 11 trillion in stock market value evaporated and millions lost their homes, these same three asset classes not only survived, but thrived. Real estate investors who understood location fundamentals saw prime properties in Manhattan and San Francisco recover within 3 years, while REITs focused on essential services generated steady income throughout the collapse. Precious metals performed exactly as they did in 1453. Gold rose from $800 to $1,900 per ounce, while silver doubled, providing the same empire-independent store of value that saved Byzantine merchants. Profitable businesses with strong fundamentals, the modern equivalent of those Genoese trading partnerships, saw their values temporarily drop, then soar as weak competitors disappeared. Warren Buffett deployed $15.6 billion during the crisis, buying businesses at fire sale prices, while unprepared investors watched their portfolios burn. The pattern is accelerating today. With $33 trillion in US debt, inflation at multi-decade highs, and the dollar losing reserve currency status to BRICS alternatives, we're approaching our own Byzantine moment. When JP Morgan Chase holds $1.7 trillion in derivatives exposure, and regional banks fail monthly, your paper assets face the same risk as Byzantine solidi in 1453. The Federal Reserve can't save you any more than Emperor Constantine could save his empire. Smart money is already moving. BlackRock has allocated $50 billion to real assets. Central banks are accumulating gold at the fastest pace since 1971. And private equity is buying recession-proof businesses at record levels. Here's your 3-step survival plan, using the exact same assets that protected wealth through every historical collapse. First, acquire productive real estate in politically stable locations with essential resources, farmland, water rights or rental properties in economically diverse cities that generate income regardless of currency fluctuations. Aim for 30–40% of your wealth in real assets that produced value in 1453 and will still produce value in 2053. Second, hold 15 to 20% of your wealth in physical precious metals, gold and silver you can actually touch, stored outside the banking system in private vaults or home safes. Not ETFs or certificates, but actual metal that worked for Byzantine merchants and will work when digital systems fail. Third, own shares in recession-proof businesses with pricing power and essential services. Companies that profit during chaos like Walmart, utility companies or healthcare providers that people need regardless of economic conditions. These businesses should generate cash flow that increases during inflation, just like those Genoese trading partnerships that thrived during Constantinople's collapse. Start immediately. Every day you delay is another day your wealth remains vulnerable to the same forces that destroyed Byzantine fortunes. The collapse pattern is already accelerating. Regional bank failures, currency debasement, and international monetary system breakdown are happening in real time. Position yourself on the right side of history before the next collapse chooses victims and beneficiaries. History doesn't repeat, but if you don't understand it, it will crush you all the same. Subscribe now because next week, I'm revealing the specific companies and locations where smart money is moving right now. The modern equivalent of those Venetian safe havens that saved Byzantine wealth.